Good evening, TC traders. Here goes the third video ever and the first of 2021. Hope you all had a wonderful New Year's and happy Happy New Year's, Merry Christmas. Hope everyone had an amazing holiday season. Took some time off. It was a nice week or two break for myself. Now ready to get back into it. So let's jump right in. I had a couple of feedbacks that my chart personally on the SPX is a bit messy in the sense that there's all sorts of lines everywhere, especially if you go to the longer time frames. It's just for some of the newer traders, it's harder to tell what's going on. So I'm gonna take a new approach. However, it might drag the video out a little bit longer due to the new approach. What I'm gonna do from now on is I'll just clear the chart whenever we go into it, whenever we go into any new charts. So first of all, this is SPX. As mentioned, we're gonna do a market deep dive to see what exactly is going on. A few things I noticed is SPX is consistently grinding along, making new highs. Nothing substantial on bear divergence wise. I mean, there is some. If you look at this RSI level consistently presents itself to be a bit of a challenge for the bulls to break. And then, yet prices keep going up. So that is a minor bear divergence, nothing significant. Bull volumes dropping off. Give me one sec here, guys. So personally, when I look at the markets, there's a few things I look at to potentially spot a pullback, consolidation, correction, whatever you want to call it, whether it's short term, long term. So I'm going to show you guys what I personally look at so you have an idea. And back when I was a financial planner at CIBC, I did there were times, back in 2019, there were plenty of signs that the market was going to correct. We didn't know what the cost would be, but as you witnessed, it did. Regardless of what the cost, through the journey of my trading full time this year, I've noticed that regardless what causes are for market to do what it does, whether it's bull break or a bear break, whether it's news, or just general TA, it's gonna happen. What's bound to happen is gonna happen. So let's go into it. First thing I look at long-term wise is the bond yield. As some of you may know, I have talked about this before to each of you individually. This is a 10-year bond yield for over US 2-year bond yield. One of the main reasons why we were able to spot the potential market meltdown coming to 2020 was the all-time low. At one point, it was actually, I think the 10 years down to about 0 point some. Now, from what we see, let's go to the weekly here. Something I noticed is ever since the crash back in February, we have been on an extremely bullish run. Again, this is 10-year yield over the 2-year yield. Extremely bullish run up until the resistance zone. As you can see from here, reject, broke through, came right back down, stall, reject, 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 and even this pop had a reject. So from here, we see that the daily is starting to stall after rejection in that zone again. That's a first sign of potential sideways market. However, keep in mind, Most of these signs, they don't play out immediately, and witnessed by, the 2020 correction. It did not play out for the longest time. Okay, just something to keep in mind. Second is VIX. Oh, one thing I gotta do, don't want to lose my drawing on SPX. And this is what I mean by the video might take a bit longer. There you go. Second thing I look at is the VIX, which is the volatility index based on S&P 500. Now, if you were to go back, I'm not going to bother cleaning this one up. Maybe just some of these old lines, but if you were to go back far back, it only went back to as far as 2014. You can see that generally what VIX does is it'll have a descending wedge constantly grinding down. And this green zone has been a strong support regardless of which time frame you look at. Okay. Yep. Then there'll be a pop. This technically is a pop, but came back, retested the support, pop again. Same thing again in 2015, long-term wedge, followed by a pop. Again. And following our correction 2020, the wedges have been a bit more shorter term. I mean, you can probably draw it on the longer time frame. Something like that, that could also work. Regardless, there's been wedges followed by a pop. Just as the volatility is inverse of S&P, inverse would be increase followed by a drop, bull run followed by a drop, and that's why volatility is the inverse. Okay. Now the most recent one I've been looking at is this one. This particular one is not as nicely drawn out as most of the previous ones. There's been ups and downs, pop over, came back down kind of thing. But we are finding some support in the 2140 zone. That is still some ways down to the strong support area of 10 to 12. But this is giving me a sense that there is potentially another pop coming, especially how we're stalling in this area with some bottom wicks coming in. Now, if you were to look at the longer wedge that I drew, yeah, this one, apex wise, it's actually not far off from a smaller wedge. Okay. Third sign that we look at is gold. One thing I noticed with gold is it doesn't seem as reliable as before, pre-pandemic. It has always been a sign that investors had used where it's a safe haven. However, with Bitcoin and cryptocurrencies coming out, gold seemed to have been a little bit more off now. So if we were to compare this to SPX, you can see that previously, the orange line is SPX. Whenever market were in an uptrend, gold will be in a downtrend. Market in downtrend, gold will be safe haven, so will be in uptrend. Okay. However, coming pandemic, gold was going up for that first drop. However, we started bouncing nearly on this same time as the market did. Then from there, the trend became very similar market to gold wise. We are seeing a bounce on gold beginning end of November, beginning of December. Something to keep in mind, however, I'm starting to, for me personally, I'm starting to use this less and less as a indicator for where the direction of the market. The fourth sign that we use is US dollar currency. And this one has yet to fail. It's similar to gold where it's a safe haven. When investors sense that there's a market correction, as we see here, investors tend to put their money towards US dollar. And main reason for that is US is one of the most liquid, most demanded currency in the world. So when we look at the US trend, US dollar trend, ever since March 19th, 18th, 17th, right around where the market started to bounce, it has been in a long-term downtrend. Now this wedge is just something I'm watching to see if it does work out. Bottom trend line seems to be working out so far. Top trend line is not perfectly drawn yet. You might want to look at something more so along, where is it? More so along this area kind of thing. Will make a little bit more sense. Regardless, one thing I noticed is there is a bull divergence forming from here to here and from here to here. So fairly strong bull divergence forming. This is another sign that potential market is giving us for bulls to be cautious on. And last but not least is one thing I'd like to touch on. It's nothing guaranteed. Again, with the market, it's nothing ever guaranteed, but just something that's nice and noticeable. So since this particular indicator that you see here is 8789, this one is called the Tom DeMark count. So what it basically does is for every candle that's higher than the fourth previous candle, they start counting 1, 2, 3, 4, 5 kind of thing. And generally when you see a 9, there is a higher chance that there's going to be a pullback in the market. You know, this one is not significant. So this one was followed by somewhat of a pullback. Yeah, so I'm looking at the weekly chart here. So the way this works, let's say 1, 2, 3, 4. This would be number 1. No, this would be number 1. 1, 2, 3, 4. This candle is the first candle that's higher than the fourth previous candle. 1, 2, 3, 4, 5, 6, 7. Okay. And what I have noticed is on this last count of 9 was followed by a decent drop, and now we're at the 9 again. Again, this is indicators are not guaranteed. It's just something to keep an eye on. The other thing is that I noticed as I was going through all the charts today before recording the video is I was going through multiple tickers, probably around 25, 30 tickers or so. What I noticed was it's becoming a little bit harder to find a nice setup on individual tickers. There's been chop around lots of names. Okay, we look at basically any name that you pick. NVIDIA is holding up. Disney's being choppy. Double chopstick top. Yeah, chopstick tops. Piton's pulling back. Ned's pulling back. I don't know. It's just, I went through lots of tickers tonight, and so that brings me to my top watch coming into this first trading day, trading week of 2021. And I was only able to find two that seemed interesting to me. I mean, on top of the main watches of Apple, Microsoft, and Amazon. Okay, so I'll go over them. The two that I found potential decent play. First is FUBO. Now with FUBO, you can see that this has been a long-term demand zone followed by a breakout, and with a short attack, what has actually happened is we are now back in the demand zone. So coming this first week of 2021, we want to be keeping a close eye on this name. We are pretty far extended from the 4-hour and the daily 80. So remember, this is most likely just a bounce play, short-term bounce. We're looking at day or two kind of thing. I will be playing this, and especially seeing last Thursday's potential volume climax. We want to see Monday having a reversal right away. Second name is QS. Now this is not as ideal of a trade in the sense that there's no significant level yet and volume climax has not been shown, but this is just something to keep an eye on going into more so end of this week coming up. And just gonna go through the three main tickers, maybe four. Apple holding daily 8, relatively low bear volume. If the daily 8 was to be lost, we'd be looking at a pullback to the 0.5, which lines up with this trend line, this yellow trend line right here. Let's make it easier for you guys. So this trend line is what we're keeping an eye on, along with the last impulsive move. If daily 8 doesn't hold, we're looking at the 0.5 and revisit of this trend line. That would be an ideal and low risk entry. Next is Microsoft. And there's not too many lines here, so you guys should be okay. With Microsoft, we held this golden pocket, bounce from it, potential reversal candle. So coming Monday, first thing we want to see is follow through. Didn't exactly come down to revisit the trend line over the wedge, but strong chart comparing to Apple. Okay. Third, Amazon. This one's a bit messier. So same idea, held at 88. Amazon is one of the strongest charts that I will be keeping an eye on going into 2021. The breakout, when it happens, we will be looking at roughly about $600 move, 680-ish. So let's say that we were to break closer to the apex, 680, we'll be looking at near 4,000. Bounce from the GP, holding the 88, ideal. I will most likely be picking up an entry this week, and that's Amazon. Last but not least, Tesla. We closed at all-time high. Congrats to Tesla bulls, as well as Bitcoin bulls. Over the weekend, Bitcoin made a new high to 34,225. We're seeing a little bit of a pullback. However, there's no significant signs for bulls to exit yet. Consistent volume, no divergence. 88 bounce, 88 bounce, higher low. Just keep that higher low in place. If you are in a bull play, keep your eyes on the 88. There's no reason for you to exit. Back to Tesla. All-time high close. Clean the chart up. This is the trend line to watch. Initial breakout, back test of the wedge, and this is why I keep most of my drawing or some of my drawings that come in handy. Back test of the wedge. Trend line, bounce, bounce. This day was the S&P uplisting. From here, we're seeing an increasing bull volume. Only red flag, big red flag is bear divergence. With some upper wick profit taking potentially. Just something to keep an eye on. No reason for exits yet. If you were in the play, use the 4-hour 8, but doesn't seem to be that good of a guideline. Use the 8-hour 8. We have not closed under the 8-hour 8 one single time. Okay, 8-hour 8 is your guide. And that's it for tonight. I will see you guys tomorrow. Good night, guys.